Hey all, this is Shubhankar here from Concept. Welcome back to another video. So in the previous video of this series, we had discussed about what are derivatives. So in this particular series, we are going to discuss why exactly participants trade in an instrument named like derivatives. Why exactly participants trade in something like derivatives. So we'll try to understand that particular thing in this video. So there are two major reasons why an trader enters into derivatives. So the first reason is speculation, the other one is hedging. Okay, the most important, I would say, characteristics of derivatives is why exactly participants enter into it is to trade, okay, to bet on something and to make money. They are not here to make any sorts of investment. So I'll just give you an example. Let's say I am liking a stock fundamentally. Okay, it can be any stock, it can be a large cap, a mid cap, or a small cap stock as well. If I'm liking a stock fundamentally or for whatsoever reason, what I would have done is I would have just gone ahead and done an investment on a particular stock. But in case of derivative segment, participants out here, their whole agenda is to make money but not to invest on something. So the major idea behind entering into derivative segment is to making money, to trade, not to invest their money. Now coming to the most critical parts. So the first one is speculation and the other one is hedging. So let's try to understand it one by one. Okay, so let's try to understand first what is speculation. So speculation is very simple, I would say. Speculation means you are betting on something. Like let's say if you are expecting Nifty to go up from here, what you do is you'll just buy the futures contract of Nifty. Similarly, if you are expecting Nifty's price to go down from here, you will just short sell Nifty's futures contract. Okay. Now, how does that help? You know, in cash segment, you can't sell Nifty's underlying, but you can short sell the futures contract of Nifty. So wherein now let's say Nifty is trading at 15,850. Okay. Now let's say 10 days down the line, if Nifty's price goes up till 15,600, that big gap which led to a drop in Nifty is going to be a profit. So I'll just explain how it works. Let's say Nifty is at 15,850. Okay, you short sell Nifty's futures. Now let's say 10 months down the line, when Nifty goes up till 15,600, that 250 rupees becomes your profit. Why is that so? Because you have sold something in advance and you are going to square it off once the price goes down. So now what is square off? Square off is simple, wherein you take an opposite position of your current position. Okay, now let's say if you have sold something, you buy it back from the market, that is square off. If you have bought something, you sell something in the market, that is called as a square off again. Okay, so you are doing an contraposition to your first position. Okay, the opposite position of it. So speculation, what I mean is, in derivatives, using derivatives, you can try to make money even in the falling markets, even in the rising markets. Even if the market is in range bound, there are certain option strategies like short straddle, short strangle, iron condors, which will give you money even if the market is flat, which we will try to discuss in some other video. So now coming to the second point, which is hedging. So hedging, now participants generally use the derivative contracts to hedge their entire portfolio, wherein I'll just give you a practical and simplest example how it works. Now let's say we are having a portfolio of rupees 10 crore. Okay, now we are expecting Nifty, or I would say the overall market, to go down for, let's say, COVID reason or for whatsoever reason. Okay, we know that market is going to go down. So now what has happened is, basically, you know, the 10 crore rupees of our portfolio has gone down up till 7 crore. Okay, that is the first scenario. Now there are two choices left with us. First one is we try to book that loss, whatever we have of 3 crore rupees, and we take an exit. Or else ultimately that portfolio of 10 crore, which is right now at 7 crore, that price would get even reduced further. It might come up to 5 crore, might up to 3 crore, we never know, right? So now what participants do is they will hedge it. Now we know that okay, market is going to go down from here in the next let's say 10-15 days. So why we should take the risk of our portfolio going down. So what we'll do is we will just short sell the underlyings. So what we'll do is we'll just short sell the futures contract. Probably we will buy some put options so that even if the market falls, we are going to make money out of that. So that is what is called as hedging. So hedging, what it is? Hedging is simple. It is I would say. So what is hedging? Hedging is simple. Is basically you are trying to minimize your losses. Your idea is not to maximize your profit, but if you are hedging something, your idea is to minimize your losses as low as possible. So that is how participants use derivative contracts like futures and options contract, and they use it to trade, they use it to speculate the market, and also they use it to hedge their entire of their portfolio. So I would say that was it from this video. So if you have liked the video, stay tuned with us. We will be posting similar sort of videos regularly on YouTube. So do hit the subscribe button, do hit the like button. Thank you. See you all in the next video.